Hi, Pradeep. Thank you so much for joining us today, and welcome to Hardick and Sanjay on WealthForum. This is the first time we're having both of you on WealthForum TV. Great to have you here, and Pradeep, great to have you back on WealthForum.
Thank you,
and
Vijay.
At the outset, heartiest congratulations to Hardick and Sanjay for being nominated as the co-heads of equity for Union Mutual Fund, and that incidentally is the first question I have for Pradeep. So Pradeep, you obviously, we've seen the press release on Vinay deciding to move on, and from a AMC point of view, maybe that's not a very welcome development, given that he's worked very closely with you in institutionalizing a lot of your processes. But you took a very sort of unusual decision not to bring in another CIO from outside who comes in with a certain track record and all of that. That seems to be a sort of template that we like in our industry. You've gone against that kind of template, and you decided to promote two of your fund managers who are now, joined us in this call, and they have both been promoted as co-heads of equity. So what's the thinking behind this move?
Vijay, thank you once again for the opportunity to come and talk to you at this, very important juncture in our journey. So yes, what we did probably might have been a little unusual by industry standards, but it's something that we took with absolutely no hesitation at all. So if we step back for a moment and look at what we have been, doing and trying to do over the last 4 years plus, ever since Vinay joined us, was to have a robust institutional investment process in our company. Yeah. And we said that we will be known for our process and not for our individual brilliance. Collectively, we will do well as a house. And this will go beyond any individual, whether it's Vinay or anybody else. In fact, Vinay was the first person who said that, we will put in place a process which will outlast me. And tomorrow, whether I am there or not, this process should work for the company. Sure. Because our view has always been that it's the process that can be repeated. Individual brilliance is something over which you don't really have much control. So, this I would rate as the biggest success of the process, that as soon as Vinay conveyed his decision, we were able to come up with our succession plan immediately, because this is a plan that we have had for the last 2 years. Okay. So it took us no time at all to make up our mind. And our board was fully supportive of this decision. And the other thing that we were very keen to do was to come out very transparently in the market about this development. Right. We thought that, it's better that, rather than leaving room for corridor talk and gossips, etc. This is something that, that has happened. It happens in the industry, nothing unusual. But the important thing is, we were ready for it, we were prepared, and we came up with our response very transparently.
And it's a sign of strength in terms of the bench strength that you have created within your company, that you've been able to come up with your solution, an internal solution, and as quickly as you've come up with. So that clearly should go down very well among investors and distributors. The only question that a lot of people may have, Pradeep, is that given that you've promoted our two young gentlemen here today as the co-heads of equity, will you sort of, and I know the last time we talked to you, you had very ambitious growth plans. Would you prefer to sort of say, okay, let's wait and watch, let them settle down in their new roles, let them sort of, get entrenched, let's see what's happening. And for that time being, let me keep my product plans, my business growth plans on hold for a while? Or do you see no impact to the very aggressive plans that you've made at the beginning of the year?
Vijay, if we had to change our plans and do something out of the way, all that we have been talking about so far over the last 4.5 years would have been for nothing.
Correct.
Right. So we maintain that, there is a process. And even today, I have told this to many people, even earlier, that you talk to Sanjay, Hardick, and Vinay, they will all tell you exactly the same thing. As far as our investments and our strategy and our outlook is concerned, nobody will miss a beat. So that is the biggest success of the process that we can claim. And it is that success that we are now, really testing out. So if we could not do what we are doing now in terms of giving the responsibility to Hardick and Sanjay, then, all our talk so far would have been really
just
futile.
talk. True.
Yes.
Very true. So on that note, Hardick, I've heard Vinay talk about this several times. I've heard Pradeep talk about this several times about how the concept of fair value it really underpins a lot of what you do in terms of your thought process on how you look at markets and sectors and so on and so forth. And we've had various interviews where we've understood Union Mutual Fund's perspective on where the fair value is today from a market point of view and why you're cautious and so on and so forth. So I'm just curious to deep dive a little bit more. What exactly goes into this fair value computation that, in your proprietary model, and where is the Indian market today in terms of how you define your fair value?
Sure. Yeah. First of all, thank you for having me. And yes, so fair value, as we have constantly in the past explained, is driven by four things. It is driven by a business's ability to grow over the future. It is driven by the ability of the business to generate return of the capital that is employed, the riskiness of the business, and the risk-free rate at which you will discount the company's future earnings. Now, in general, the higher the capability of a business to generate wealth for its own promoters, or its own investors, the higher the worth of that business. So higher the ROE, higher the fair value. The faster a business will grow over the long run, the higher will be the fair value of that business, if assuming two businesses have the same return on capital. Now, even if two businesses have the same return on capital and the same growth potential, if one company is a steel company having a lot of volatility along the way, and the other one is an IT company which is growing more steadily, the riskiness of one business is higher, and hence the fair value will be lower. The risk rate for all businesses in the country is the same. So that's not a differentiating factor, but it's an important factor while determining what the fair value is. So these four things are calculated for each and every company we own.
So that's ROE, ROCE, market volatility, and risk-free return.
It's the return on equity. It is the growth rate in earnings.
Okay.
It is the riskiness of business and the risk-free rate. These four things.
Okay.
And we do this for all the companies that are there in the fund house universe, and also the companies that are outside the fund house universe. Because to be able to say that my companies are benefiting or other better positioned in these metrics, I need to observe the universe outside my fund house to ensure that I actually have the faster growing and faster ROE generating businesses, more consistent businesses. Right. So that's how the method works. Now,
and at a
how
market
does the
level, what are the parameters that you?
So once we have calculated the fair value of a company, we also calculate the fair value of each and every Nifty 50 constituent. And we use that to judge where is the market today. So,
so you basic bottom up, you don't go top down, like no. What is the, P of the market and all, you don't go that way.
That's not how it, we do this for individual each and every constituent, and then simply use the laissez-faire index method to basically create the fair value of the market. And fair value actually as a concept has helped us a lot. For example, in the pandemic, if I was to say, this will also help me tell you where the market is today. When the market corrected by the way it did, we try to explain that fair values are not as volatile. They are more stable businesses. So when the market corrected, I think in March 2020, there was an expectation that EPS of Nifty will fall by 30%. That is somewhat the same level at which the market also fell. And what we try to explain is that assume if you have a real estate apartment for 2 crores and you have basically given it on rent for 3%. So you're making about 6 lakhs of rental income every year. If because of pandemic, you don't get 1 year, half a years of rental income, if your rental income halves, you will not sell your property for 1 crore now. So in a long line of assets, long life of the asset, only half year's rent is lost. Same ways businesses fell more than in terms of valuation than the fair values did. So for every 100 rupees of fair value of the Nifty, you were getting it for 70 rupees. Markets were trading at a 30% discount. Today, for 100 rupees fair value, you are having to pay 110 rupees. So markets are getting a 10% premium in this environment. Now, should it be equal? Should 100 be only available for 100? Not exactly. Fair values, if they are growing at a fast pace, they always will deserve some premium. So markets are expensive, but way more attractive than what they have been in the last 18 months. In terms of relation to their own fair value. So what we are hence recommending is that participate. in a staggered manner. There is still some slight expensiveness, which probably can get either time corrected or there can be some small absolute fall. So participate in a staggered manner in the market to benefit from this volatility rather than avoid it and stay away.
Got it.
So that's the recommendation on the
That makes
broadly
very
how
good
we see the
sense. Now,
market.
if you could just break this down for me, Hardik, market is at, let's say, 110 against a fair value of 100. I've understood that.
100.
And you also told me that you build up your 110 bottom up by looking at each of the Nifty 50 constituents. Now, within this 110, which are the sectors that are less than 100, which are on an absolute basis, fair value? And which are those sectors which may be above 100, but you still have a positive stance because of higher growth prospects? And which are the sectors that you're avoiding because they don't fit into either of these?
So at this juncture, sectors which are, I'll tell you which are the sectors which we are finding relatively still some discomfort, are sectors which are dependent on the global economy. Where if some things happen which are not expected, there is worse than expected growth rate in the Western economies, some sectors will be affected more. The global GDP will have a bigger bearing on them. So let's say IT or metals, commodities in general, which are focused. These are the sectors, even some smaller sectors like tires or some such, which are dependent on the global demand supply situation, either on the raw material pricing or the demand for the products they sell. These are sectors where we are avoiding because we see the fair value risk. If we think it's available for, let's say, even 100, for a fair value of 100, there's a risk that 100 will go down a bit before starting to climb up. So sectors that are dependent on global economy, we are underweight. So IT and metals predominantly. Sectors which are closer to home, where the growth story is largely dependent on the way Indian economy and the Indian consumption is going, that is where we are more positive. So banks, NBFCs are one areas where we are very positive. We are overweight, where we feel that while it might be available for more than 100, the price makes sense. Growth can be very strong going forward. We like consumer discretionary plays. So we have been doing a lot of roadshows, me and Sanjay, and we've been seeing that there is so much of consumerism being displayed on the ground. And to that extent, consumer discretionary plays like auto, retail, either it's apparel or it's electronics, broadly companies which are playing on this theme. And of course, the
consumer discretionaries, are they at that 100 or 110, but yet a buy because of the growth prospects?
They will be always at above 100 because these companies are expected to grow at 20% CAGR. So at a much faster pace than the nominal GDP. So you always will have to pay an extra rupee for it, but it is justified at this juncture. So yeah, that's how we are looking at the overall sectoral positioning, apart from banks, consumer, and infra related plays, because India will need that infra push to continue to see the growth we are projecting. That these are sectors we are actually overweight on.
Makes very good sense and explained very clearly. Thank you for that, Hardik. Sanjay, the other factor that many intermediaries have sort of noticed of Union Mutual Fund is the work that you've done on understanding factor-based investing in the Indian market context. Your fund house had come up with a very interesting white paper on that some time ago. I'm just curious to understand, to what extent have you embraced factor-based investing in the investment process that Hardik just mentioned? Is there also some weightage given to which factors are having a lot of bearing in the market at that point of time, and therefore even if it's at 110, as Hardik was mentioning, we must take it because it's a factor in play kind of a thing?
Sure. Thanks Sujay for having us. Definitely. So factor investing is very interesting way of looking at companies and sectors, and in fact it goes to look at the fabric beyond what companies are today, right? So it tells you the long-term picture beyond just what is visible in the near term. So definitely factor investing plays a major role in the way in which we look at all the companies. The fair value approach itself, as Hardik mentioned, goes from growth in earnings, which is an income statement focused variable, return on equity, which is balance sheet focused variable, risk of the business, which is in-house variable, and risk-free rate, which is a macro variable. So in short, the 360-degree approach itself is one very unique way of looking at this fair value approach, which we have developed in-house. And definitely, as you highlighted, there is a way to change the variables from this growth value as well as on the quality parameters when we are constructing a portfolio. So definitely, we are trying to institutionalize this framework of thinking in terms of growth, quality, and value parameters, which will look at objective data points when we are constructing a portfolio. So there will be portfolio construction process and stock selection process, which will definitely rely on this factor investing when we are constructing portfolios.
So does that also mean, Sanjay, that as a fund house seeks to embrace factor-based investing within its overall mix, you might see less of buy and hold as you see factors driving the market in a particular way? You say, okay, look, if momentum, suppose you're taking momentum-based investing as one factor, and you're saying momentum is now there in this particular theme for whatever reason, right? Then would you then go a lot more overweight there? So are your portfolios likely to get a lot more nimble and dynamic because you're including factor-based investing?
Sure. So currently we are focused on 3 factors of growth, quality, and valuation. So these are the 3 factors which we are currently including in our portfolio construction process. And since you understand that our focus is on the long-term way in which the companies are able to grow, the long-term way in which these quality parameters are displayed by these companies, that's why in a way process is designed to take out all the noise which is possible in the short term and focus on the long-term way of creating wealth for the investors or long-term way of how these fair values are growing. And that is the way process is expected to perform. So in short, we are focused on the long-term way of wealth creation through these factors. And rather than getting swayed by all the noise in the market, these factors will stay put from the long-term perspective.
Got it. Got it. You're also now, Sanjay, in the eye of the storm in the sense that you are launching an NFO at a time when there is this change in your investments team. And as Pradeep said, if he were to push back the launch of this product, then everything that the company had planned for didn't really work. And proof of the pudding is that you're going ahead with your fund launch. So congratulations. All the very best for your fund launch. Question though for you is, multi-cap, yes, from your company's point of view, obviously fills a gap. There is no doubt about that. You always will have a challenge in terms of how to differentiate your product in the marketplace. So what's the pitch that you're giving into the distribution fraternity for communicating to investors about why they should consider Union Mutual Fund's multi-cap product?
Sure. Thanks. So process itself is very different and unique, as Hardick highlighted, on the construction of this fair value, right? It encompasses all the aspects in which a company is generating the cash flow or generating wealth. And when we say power of compounding in the equity, we are focused on this formula 1 + R raised to N. Our focus is on the N part, which is generating over a period of a sustainable way of generating return over a period of time, rather than just short-term trends which may come up and go in the market. So focus is on the different variables than maybe, so that is one way of differentiating. Another way of differentiating because of this fair value approach is also that in the mid cap and small cap particularly, our idea generation or stock selection has been quite different than peers, where we are focused is on the long-term growth of these companies and where these companies can actually be over a period of time, when we are focusing on 5 years, 10 years, longer period of time. And that's why stock selection will be a differentiator in the mid cap and small cap. And in the large cap, the same approach of fair value, along with the fundamental way of creating portfolios, we have been able to generate or able to identify the opportunities, which are mispriced opportunities in large cap. That's why some of the calls which we took in January 2022 of going underweight IT, those played in a quite a favorable for us over a period of time. And that is the differentiating ability which this process is contributing to the portfolio construction process. So in short, process is different. In mid and small cap, idea generation, stock selection will be key. In large caps, identifying this mispriced opportunity will be the key from overall strategy perspective. And,
I saw one slide in your presentation deck, which talked about how in the multi-cap universe, your peer group is roughly 27-28% each in mid and small, and then the balance is in large cap. Are you also likely to be, when you cast your initial portfolio, is that also likely to be the same thing, like anywhere 25-27% in mid and small caps, or are you thinking of going a lot more in mid and small.
So, Vijay, current our view is that we are overweight large caps versus mid and small cap category, mainly because of the different macro variables which are at play, the volatility which may be seen over next 3 to 6 month time, particularly from the macro perspective. That's why currently our stance is we will be overweight large cap versus mid and small caps. So based on when we will be actually implementing this portfolio, situation may change a bit. But currently, we'll be overweight large cap versus mid and small cap. That remains to be the stance.
Got it. Got it. So all the very best to you, Sanjay, for a very successful NFO. All the best to Hardick and Sanjay for taking on your new responsibilities and driving the investments, the equity franchise of Union Mutual Fund to greater heights. And Pradeep, I'm sure it's very visible that the bench strength that you built is very high quality indeed. Congratulations on that. And wish you and your entire team all the success in this NFO and the rest of your business plans for this year. Thank you for joining us.
Thank you, Vijay.
Thank you, Vijay.
Thank you. Thanks for having us.
Thank you very much.